Good afternoon, welcome. You're watching your trades on ET now. A quarter of a percent down on the Nifty today, 2.5% down through the week. Srishti, it's been a weak market. Today we thought it started with some amount of resilience, but not to be.
Well, yes, absolutely, Harsh. And this is your trace for the weekly edition where we wrap up the whole week action for our viewers and not just that, also get them ready for the next week. And talking of this week particularly, not a great week coming in for all the bulls out there because it was a monthly options expiry this week, and we also started a brand new option series as well. But for the week gone by, we have seen in the last week of the monthly expiry, Nifty managed to break all those gains, or lose all those gains what Nifty 50 index made in the previous 3 weeks. And for the week gone by, Nifty 50 was down about 2.8%. Similar kind of declines we have seen coming in for Bank Nifty as well, which was down about 3%. Along with that, some of the sectors that was the biggest laggards in the week gone by, leading the charts was metal index that was down about 6.3%. As we know, it has the inverse relationship with the dollar index. It was seen to be inching up higher, and this was followed by a decline in realty sector, which was the second biggest loser when it comes to the sectoral performance. Have to say that the broader markets did perform relatively better in comparison to the frontline indices, but of some of the stock specific action, we'll be highlighting Adani group of stocks which were once again seen to be under pressure, and Adani Enterprise was down about 24% in the week gone by. Other than that, Z Entertainment was one of the biggest news makers for the week, down about 9%, and it also had a negative news where NCLT has admitted the insolvency petition of IndusInd Bank against the company, but a relief coming in as the company approached NCLAT, where they got some bit of a relief for the next hearing lined up in the March, and the stock was seen to be recovering on the Thursday as well as Friday session. Along with that, SCI was in focus after the Corporate Affairs Ministry approved the demerger plan of their non-core assets. And along with that, Electra Green Tech from the auto space was seen to be flying high with 19% of uptick coming in Friday's session as the company says that in the next 1 year they will be coming up with their hydrogen bus. So that's all about how the indices performed as well as some of the newsmakers for the week gone by. But the big question is that as Nifty managed to break that 17,500 crucial support for itself, what's lined up ahead, especially when it comes to some of the triggers that we will be watching out for and discussing in detail going ahead. But let's move forward and get our experts onto the show. For today, we have Rajesh Palviya, who is the head of technical and derivative research at Axis Securities, and along with that, we have Mahantesh joining us as well. Rajesh, a very good afternoon to you. Firstly, coming to you, what are the levels that one should be watching out for Nifty 50? Because as I highlighted, 70,500 is seen to be broken right now. So as we start the brand new options expiry, what are the levels that you are eyeing for?
Yeah, good afternoon. So, if we go with the rollover data, also the 73% rollover was there for this series, and it's almost lower from the previous month series. Looking at the overall setup for Nifty, Bank Nifty, it's a short rollover was witnessed in this series. In the beginning of this series, we have seen again, today's session also, we have seen, some more short bets are added in the system. Looking at the setup on the option front also in today's session also, we have seen, call writers were very aggressive at 17,600, even 17,500 strikes, which clearly indicates that, still market participants are aggressive on the shorting on the market. On the level fronts, yes, we have broken this 17,500 important psychological as well as the put concentration area also in the today's session. So now if we continues to trade below 17,500, then possibly furthermore a sell-off we can see in the coming trading session, and possibly Nifty can go down towards 17,300, even 17,200, which are the next support area on the downside. Even on the Bank Nifty also, the major call writing activity has been seen in the today's session at around 40,000, 40,500 strike, which clearly shows that, till Bank Nifty not crosses above these level, pressure is going to remain in the Bank Nifty also. and as we have broken 40,000 level in the today's session, so if we continues to open in the next week below 40,000 level, then possibly there could be another pressure we can see in the bank nifty also, and the next level for bank nifty on the downside would be around 39,500 to 39,300. So both the indices are looking still weak, and sell on rise should be the strategy till nifty not manages to cross above 17,750, 17,800 level. Whatever pullback will get will meet to the supply on the higher side. So sell on rise strategy on the nifty also, and for bank nifty 40,500, 40,800 are the key resistance area till bank nifty not crosses those level. Again here also one can adopt a sell on rise strategy for bank nifty also.
Right. Let me switch it over to Mahantesh. Thanks for that, Rajesh. Mahantesh, talk to us with regard to Nifty Pharma. Of course, now you're looking at, are you looking at pharma more constructively? We saw a couple of names give a good rally, GSK Pharma, Sanofi today, of course, and we also had Divis Labs, which saw 3% uptake through the week. So how are you looking at pharma now?
I think the pharma sector as a whole has been going through a lot of pain post-COVID simply because I think the overall traction that is to be seen in terms of their revenues and growth ahead has been quite subdued. But now we have reached a point where we should be able to see much heightened growth. US exports has been a big problem for most of the pharma companies. Somewhere I believe now that phase is over and they should be looking up. But fact remains that pharma continues to remain a defensive sector. So some of the outperformance that we have seen in recent months has got to do with the fact that the overall market is remained subdued.
That's the take coming in on the pharma sector. But Rajesh, coming to you and continuing with the defensive theme, Nifty FMCG was one particular bag amidst the sell-off. This particular sector did manage to show some resilience out there. What's your view on the Nifty FMCG sector and going ahead? Because you have a sell on right strategy for both the frontline indices, do you expect like sectors like pharma as well as FMCG to come in? Try to lend some support to the sell-off that is expected in the markets from your end?
So, Shristi, some of the pockets, yes, clearly showing, buying interest. One is capital goods, second is cement space, third one is your automobile, and fourth one is oil and gas. These sectors are clearly showing some buying. So, dips are, again getting the support in this all this sector. So yes, Nifty FMCG is also showing mixed behavior. Some of the stocks are doing good, like stock like ITC is almost trading near to its all-time high trajectory. So ITC is one stock which we like from this FMCG space, and we believe that ITC can show furthermore bullishness in the coming trading session. So one can look at ITC to remain on the long side, or you can initiate your bullish trade in the ITC. And as the stock is trading near to a 385 level, so one can keep stop loss of 375 for upside target of 425 to 430. Another stock from FMCG pack that we like at the current juncture, that is Asian Paint. Though stock has corrected significantly in recent past, but looking at the behavior of the price in the last couple of week, that now stock is recovering from its oversold zone. Looking at the overall setup, now stock is trading near to its multiple support area of 2700. So if it continues to hold about 2700, then possibly some short covering we can see in the Asian Paint, and possibly stock can show some bullishness towards 2850 to 2900 on the higher side. So one can look at Asian Paint also from this and Nifty FMCG pack.
Yeah, right. I'll move to Mahantesh and I'll take a cue from you, Rajesh. ITC, Mahantesh, stellar run over the last year or so. How do you look at valuations now? Dividend yield still quite decent. How would you rate the current valuation of the stock, and where would you see it go from here?
I think most of the run for the ITC stock is in a way over. Remember, one of the primary contributor to the ITC's run was the fact that the taxation burden on cigarettes for the last few years has been minimal. Normally, we always used to associate every successive budget posing newer kind of taxation burden over a cigarette, but that case is no longer there. In fact, cigarette volumes were on a degrowth trend a couple of years ago. Now that trend has in a way reversed. But the quick run of the stock tells me that somewhere that the valuations are nearly full. Of course, ITC relative to, let's say, a Hindustan Lever always trades at a discount. So that discount will kind of continue to remain, but that discount has narrowed as I see it, and I don't see further upside to the stock. Buying an ITC merely for a dividend yield kind of story is perhaps foolish, because you know that this stock is also prone for falling down as we progress ahead, and the upcoming year could be crucial, simply because we're gonna see some measure of taxations come back and hitting the stock as the government approaches its end of term.
Right. Thanks so much for that, Mantesh, for sharing your views on ITC. But with that, we'll slip into a very short break. More on the other side, so stay tuned.
Welcome back to the weekly edition of Your Trades on ET Now, and let's once again go ahead with the discussion with our experts. We have Rajesh Palviya as well as Mantesh onto the show, and Mantesh, coming to you for the next question that I have, and that's on the auto space. Next week we have the auto sales that is lined up, and on Friday's session we have seen some of the counters like M&M, Tata Motors as well as Eicher Motors were under pressure. But going ahead, as we are hearing a lot about the recession as well as inflation, the rate hikes also expected to be continued. What's your view on the auto space? Some of the stocks that are already near its all-time high levels, like M&M and TVS Motors, with the recent sell-off in the markets, do you feel that this is a good time to book some profits in some of these counters as well, or do you believe that the longer term story for the whole of the auto space is still intact?
So firstly, there is a near-term pressure on the automobile volumes that is coming from the rise in interest rates. As you are aware, most of the automobile sales are happen on loan. So with rising interest rates, that leads to lower demand. That being the overall macro story for the automobile segment right now, the only good thing that is happening is the raw material cost pressure is gradually easing for most of them. So therefore, we should be able to see from a profitability perspective better profits being posted by the automobile companies as we go ahead. But is that in the price for the sector right now? I reckon yes, it is. Most of the stocks have had recent short run up that has almost priced in the gradual profitability improvement that's likely to be seen in the year ahead. So I'd be a little cautious about being overexposed into the sector. One would rather remain underweight. If one is overweight, it obviously means that you have to cut down your weights by selling certain stocks.
Right. Thank you for that, Mantesh. Let me move over to Rajesh. Rajesh, talk to us. This week was, quite tepid, if I can describe it. How do you look at it next week? What are your top picks?
So as I mentioned that we like oil and gas sector, and from that space, some of the stocks has shown very good buying interest even in this kind of market. Stock like GAIL, Petronet, ONGC. So from that space, we believe that ONGC can be a stock where one can take a long position. And looking at the overall setup for this ONGC, we believe that this stock can exhibit further more bullishness in the coming week, and we are projecting a target of 165, 168 in this continuation of this uptrend. One can buy with stop loss of 148. Another sector which we mentioned, that is FMCG, and from that space we like Radico Khaitan. Stock has given breakout of its falling trend line on the daily chart, and looking at the daily setup, it's third consecutive week, third consecutive day where stock is forming higher high, and now stock is trading about 20-day, 50-day moving average. The kind of volume action which we have seen since last 3-4 trading session, we believe that this up move can continue further. 1210 to 1220 could be the possible target in the near term. One can buy with stop loss of 1150. Another stock that is looking very interesting after a decent corrective action, now stock is giving sign of recovery, that is PB Fintech. Very strong buying action in today's session, and now stock is showing strength to continue further up move from the current level. Also, the kind of breakout which we have seen in the today's session, it clearly shows that now stock can scale up further towards 620, 630 in the continuation of this up move. So one can buy PB Fintech, Policy Bazaar with stop loss of 555.
Even though Rajesh has a sell on right strategy on Nifty as well as Bank Nifty, but other than that, he has on the stock specific recommendations, 3 buy calls coming in for ONGC, Radhika Khaitan, as well as PB Fintech making in on his radar. But Mantesh, coming to you, amidst this environment where we have so many news flows regarding the recession as well as inflation rate hikes, but going ahead, which are some of the sectors that you should be looking out for amidst the India growth story? And other than that, on the valuation front, which will be your sector that you will not like at this point in time and wish to stay away from that?
So firstly, I think it is very clearly visible that there is a capex uptrend that is likely to happen now going ahead. There is also increased focus by the government on capital expenditure, which tells you that we should be, from a macro point of view, focusing on the capital goods sector. Obviously, the capital goods sector has done its bit in terms of the recent kind of run up, but that's one sector I would still continue to bet for the year ahead. Uh, the second sector that one should really look at is from the interest rate point of view. Interest rates are possibly peaking now. We are closer to the rate hike end of the rate hike cycle. And therefore, we should be able to see banks starting to really outperform as more credit penetration happens, more credit growth happens. It will come with its own problems about NIMs getting compressed, but the overall picture tells you that the credit expansion itself will be very beneficial to most of the banks. Remember, most of them are also, from a credit quality perspective, low on the NPA levels already. The books have been mostly cleaned. So these are the two sectors one should be really betting on going ahead. As far as the sectors to avoid going forward is consumer durable is something that I would be a little careful about because inflation worries are still there. Interest rates, like I said, we are approaching the end of the peak rate hike cycle, but the interest rates hikes are still likely to be there for one or more policy meets. That tells you that consumer durable goods may not necessarily survive this interest rate hike coming at a time where these consumer durables will typically see peak season demand around the summertime. So would be careful and avoid that particular sector. The consumer durable sector is what I'm talking about to avoid.
Right, thank you for those views, Mahantesh, as well as Rajesh. We'll let you go on that note, and thank you so much for all of those insights that you gave us with regard to stocks and sectors. Let me quickly move on.